Welcome back to The Energy Forum, a podcast from the Center for Energy Studies at Rice University's Baker Institute for Public Policy. I'm Ken Medlock, Senior Director of the Center for Energy Studies. This episode comes at a moment of increased volatility in global oil markets. Over the past several days, escalating conflict between Israel and Iran have driven a significant increase in market risk and sharp movements in oil price. Given the importance of the region for global oil market balance, even a perception of heightened risk can send shockwaves through the market. To unpack it all, we're joined by Abhi Rajendran, a non-resident fellow at CES and Director of Research and Advisory at Energy Intelligence, and Skip York, a non-resident fellow at CES and an expert in global market dynamics and upstream strategy. They'll explore what the latest geopolitical developments mean for oil prices, supply dynamics, and the broader outlook in 2025 and beyond. Abhi, Skip, take it away.
Thanks, Ken. Skip, great to have you on. There is a lot going on and certainly a lot to talk about and discuss. So why don't we just start with the developments over the last couple of days, over the weekend. It's certainly been, as it has been a couple of times over the last couple of years, kind of an eventful, geopolitical environment, and certainly the energy market has been on watch as well. So, how are you thinking about, everything that's going on in the Middle East and how it might impact the oil markets?
Yeah, I think it's important. I always try to keep a couple of facts in mind, especially when you're thinking around risks around the Middle East. And, you see how, oil prices were up about $5 or $7 on Thursday and Friday. Here we are on Monday morning and prices have dropped $2.50, $3 a barrel. And it all goes back to the perceptions and the changes of risks, right? And so why is the Middle East so risky? Let's just remind ourselves of a couple of things. Is that about 20% of the world's oil and about 20% of the world's LNG flows through the Strait of Hormuz. And so when you have an increase in the tension or actual conflict, as we see right now, breaking out between Israel and Iran, there's always that perception that there's a chance that those straits are going to close. And there's all sorts of scenarios as to how could those straits actually close. And what you see, I think, the way I'm thinking about this is what the market's doing is we're seeing that $5 or $7 change is the culmination of a bunch of actors in the market saying, if there's something happened in the Strait of Hormuz, what would the change in the oil price be? And what's the probability that I'm assigning to that change in the oil price? And we don't know what each individual actor is assigning to that price change, and we don't know what the probability is. But the sum of all those perceptions is being rolled up, and we see a $5 per change. So I think what the market's telling us is that the risk to that supply in the Middle East is $5 a barrel higher than it was, say, at the beginning of last week. And that's really all the market's telling us. It doesn't tell us what the probability of there being an interruption in the Strait of Hormuz is, and it doesn't tell us what happens to the price if there was an interruption in the Strait of Hormuz. It just tells us that the market perceives a greater risk now than it did a week ago. And if you look at what's happening today on Monday, June 16th, it's telling us that with Iran signaling that it might be willing to restart negotiations, that risk is now unwinding. But it hasn't completely unwound because we haven't gone back to where oil prices were, say, last Tuesday or Wednesday. So it's just the characteristic volatility of what do markets not like? Uncertainty. What has the last 4 days induced into the oil market? It's induced uncertainty, and that's creating volatility in the market.
Yeah, and I think that $5 change is probably fair, right? I mean, I think, risks still, are out there in the market. There are still pretty large question marks about how this all unfolds. And, and certainly, as you pointed out, I mean, while, Iran has made some indications and signals that it may be willing to come to the table, there are other things also going on, right? Like trying to potentially pull out of the NPT and then whether, those become, kind of bigger political and geopolitical concerns for in the region and also more broadly the world to deal with. So certainly a lot to unfold. I would also add part of it too is, I think, part of the reset higher in prices is just like it's hard to, if you're if you were positioned short, right, oil in this market, it's hard to remain so because the situation still is pretty fluid, and there are still attacks going back and forth. We're not, in kind of a ceasefire type environment. So that higher price environment is fair. Maybe another broader question for you, how should we kind of think about the perception from Washington, from President Trump, the appetite for slightly higher prices or not, and also how does kind of OPEC Plus factor into this, right? They have already been adding supply, so that's already kind of getting into the market, even if the actual supply additions have underwhelmed to some degree.
Well, I think, I guess it's fortuitous for OPEC Plus that they've made the last three announcements, right, of increasing, substantial increases in supply. And you're right, what's actually come to the market has been less than what the announcements have been. But at least the world can't blame them for holding world oil demand hostage by keeping capacity spare because they have announced that they're bringing more supply to the market. So it was fortuitous for them that they did acknowledge that they were bringing more supply. The IEA did announce that the market, I guess, was on Friday. The IEA did announce that the markets appear to be well supplied. There are strategic stocks out there, and they are monitoring to whether or not there needs to be a release. So, exactly what the IEA needs to say. So far, everybody has kind of done what needs to be done in order to try to manage the uncertainty in the market, there's the uncertainty in the market, and then there's trying to reduce the speculation and the fear, right? There's one thing about managing uncertainty, and then there's other thing about the other side is trying to manage the fear in the market. And I think everybody's kind of done what they can do to try to manage the fear in the market and then mitigate the uncertainty. I think OPEC Plus now has, if they didn't have the incentive before, I think the incentive is now there to get the operations going and get those barrels into the market. And we'll have to now see. I think it'll be interesting to see as we move through June and into July. Do we actually see more barrels coming out of OPEC Plus than we anticipated seeing in the month of June, say just a few weeks ago?
Yeah, no, all good points. And oil prices, as you noted, have been kind of all over the place over the last week, but now, we're kind of hugging around $70 for both WTI and Brent. How do you think about what a fair price should be, or a fair price range should be right now in the market? And then how are you kind of thinking about, fundamentals, right, as we, kind of get into the summer months?
Yeah, I think, we saw a couple of things, where OPEC has kind of said that they thought underlying demand was stronger than what some other reporting agencies thought. We saw EIA's upward revision of historical demand, which kind of lend a little bit of credence to OPEC's views. And we do see that the beginning of the summer in the Middle East has been very hot, and that's pushed up the seasonal increase in oil demand for power generation in the Middle East has happened sooner, and it's a bit faster, or it's a bit bigger than we've seen. So you sort of say that right now, the oil demand is a bit stronger on a seasonal basis than maybe it would have been on sort of on a normal basis. So, prices are probably should have been firming a bit from where they were in the earlier spring. And then you lay on top of it that OPEC Plus hasn't been returning as many barrels. And US shale has been pretty flattish, right? For the first half of the year. We haven't seen a whole lot of growth out of the US. So I kind of think, upper 60s, low 70s is kind of where the market maybe should have been. Well, it'll be interesting to see if these tensions in the Middle East resolve themselves. Where does oil settle back once those uncertainties and that tension resolves it? If it resolves itself, where does oil settle back to? Does it settle back? Does it drift back down into the lower 60s, or does it sort of settle into the upper 60s, which might be a bit more reflective of where demand is right now, sort of in the middle of the driving season in the Northern Hemisphere, and that cooling, the need for power generation for cooling in the Middle East, the combination of those two sort of firming up demand in the summer months over the next 2, 3, 4 months.
Right. And on, as demand, let's say it kind of plays out as expected. But if we were to have kind of a temporary or transient, supply issue or shock, is it really only, OPEC Plus that has the flex to kind of meet that? How are you thinking about U.S. supply, for example? You reference, shale kind of flatlining and then capex getting trimmed there. Are there reserves and strategic petroleum reserves, in the U.S. or other places that can weather some of the shock? How are you thinking about that?
I think there's three things to bite off there. We do have strategic stocks. We did drain them quite a bit, especially the US in 2022 at the beginning of the Russian-Ukraine war. We haven't rebuilt those stocks very much. There's still, I think, directionally 300 million barrels in the Strategic Petroleum Reserve for the U.S. So it's not like it's empty. It's just not where it was before. So there are reserves that they can pull from. We still have strategic reserves in Japan and Europe as well. So there are reserves out there. I think the IEA has kind of signaled those would be the barrels of last resort, and that's the right way to think about them. You would like to sort of say, could we replace barrels if we do lose production barrels in the Middle East? Could we replace them with existing production or new production someplace else before we dig into the reserves? And then you look at the U.S., where's the fastest responsive barrels you could get? Well, I think there's kind of two ways to think about that. One is U.S. shale. We have lost some rigs, but those rigs are warm stacked because they just came out of the fields over the last few weeks. Those drilling rigs could go back into the fields fairly easily because since they just came out of the fields. The question is going to be, do we have the fracking crews once the well's drilled that we could get the completions to get the crew to get those wells into production? That's a bit of an uncertainty for me. I'm not sure where we stand. How fast could we reactivate fracking crews to get to the completions? The other lever that the administration could think about is restoring Chevron's export permit, or permits in Venezuela, and allowing Chevron to go back in, because the consensus is, with Chevron having to leave at the end of May, over the course of 2025, Venezuela production was going to go down about 200,000 barrels per day. Well, you reactivate those permits and you allow Chevron to come back in. That's 200,000 barrels a day of production that the world isn't going to lose if the Trump administration were to reactivate those permits and allow Chevron to go back into the country. So there is a lever there that the government could pull. The shale is going to be a market response. You're going to need a market price signal to get those rigs back into the field and also to get those fracking crews reactivated.
Yeah, and I agree with you on the last point. And I think that signal, that response, is going to have to be, much higher prices and with a decent amount of duration to those prices, right? I think, a rebound back to the 70s isn't going to do it. You need, 80s and, signs of a sustained, supply issue or a hole that needs to be plugged. So I think, I would still think that this flatlining and potential decline to the cadence of U.S. oil supply led by shale is probably still on the cards over the next, call it, 6 to 12 to 18 months.
Producers have to see a pathway to the upper 70s or the 80s before they react, right, before they start making a move.
Exactly. So let's talk about, like a little bit of that medium term, right? I think because there's a lot of moving parts for the short term. We'll see how the Middle East dynamics and other, geopolitical variables play out for the next, month or two. But let's look at the rest of the year and into next year. Maybe you can talk a little bit about, how you're thinking about the supply demand balance. In particular, I think, Chinese demand is one to watch because sure, there have been some cyclical things going on there over the last year or two, but there are also structural and secular changes happening as well. So how should we think about that? What are some of those moving parts? And then what should the market be looking at, even looking to 2026 and beyond?
Yeah, I think what we might be seeing in China, we're seeing several years now where we might be seeing this rotation in China, where if you step back and say that the big macro view is that China is rotating from being an export economy to sort of more of a more mature service economy. So it's going from looking like an emerging economy that exports a lot of its GDP is based on exports, to looking more like a mature advanced economy like the US, which is based much more on internal consumption. That's a completely different energy requirement from, that energy requirement as a service economy, an internal GDP service economy is a completely different energy requirement than an export economy. And I think we're seeing that transition is going to be over the next couple of years. And I think we're starting to see elements of that in diesel fuel, where diesel fuel came out of COVID with some growth, but it hasn't recovered really to the pre-COVID levels, and it's kind of flattened out. On the structural side, another structural side is, China making this decision that as it wanted to improve mobility for its population, it had the ability to make the choice about, do I want mobility through electrons or do I want electricity through liquid molecules? And it made the choice to do it through electrons. And that's why we see that penetration of electric vehicles, which now I think we're now 5 or 6 months in a row where electric vehicles are now more than 50% of sales in China. And that sort of flattened and possibly peaked gasoline demand in China. And we might be seeing that downward drift in China. So that says transportation fuels could be flattish to declining. The growth in oil demand in China is on the feedstock side, meaning we still see growth and propane into residential heating and cooking, but we also see a lot of growth into the lighter end of the barrel, into petrochemical feedstocks, into the manufacturing base. And so China's demand barrel is starting to change its shape, and that's going to have implications for not only the total oil demand, but it's also going to have implications for Chinese refiners and the China supply demand balance, because you don't get to just choose what you want to produce. A refiner has to produce a slate of products, whether it needs those products or not. So we might be seeing some interesting changes in China's supply demand balance and what it imports and what it exports over the next few years, as it has to balance itself internally. It needs the petrochemical feedstocks, but it may not need the gasoline, and maybe it doesn't need the diesel. And we start seeing those products maybe starting to find their way into the international markets. And you think about gasoline, where gasoline globally might be approaching a peak, and you've got the Chinese potentially exporting gasoline and maybe other countries exporting gasoline as well. Now that's not a 25 or 26 issue, but as we start getting towards the end of the decade, we could start seeing some really interesting things in how product balances around the world have to start rebalancing themselves in order for refining markets to clear. And that's going to have impacts on refining margins, both locally and internationally.
Yeah, no, absolutely. Yeah, it's going to be, we're already midway through 2025. It's going to be a fascinating, 3 to 5 years as we get, towards 2030. And I think, to your point on the implications from, the structural shifts in China, that certainly has, an impact and implications for producers as well, right? In particular, OPEC plus, looking to feed that market, including some of the sanctioned barrels from Russia and Iran as well, with China being a big market there. So certainly a lot of things to watch. In terms of bring it back to just kind of oil prices, oil markets. How do you think about where oil prices will settle out? Once we kind of get through all the near term noise, and also some of the rebalancing, right? Leaving the geopolitics aside, I think you could argue the market has maybe a little bit more supply than it needs, but some of those moving parts are changing, right? In particular, U.S. supply. So when it all shapes out in the next 6 to 9 to 12 months, where do you think oil prices settle out? And I'll chime in on my view as well.
Yeah, I think if we resolve the tensions that we've seen over the last week, if that resolves itself, and we get back to sort of just say the pure market fundamentals, or as pure as the market fundamentals can be in the oil market, then I would say that sort of the balance of this year, I think we're probably still looking at a world in the 60s. Maybe it's the upper 60s, the mid to upper 60s. But if we get into 26, I think we see a market that might be moving into the 70s, because, and here's what my premise is if we're in the 60s, we don't see a lot of growth in shale. We see a flat shale world, maybe some decline on the back end of 25 heading into 26. This year, demand growth will be less than 1 million barrels per day, call it maybe 700,000 barrels per day. If we go back to normal of about a million to 1.2 million barrels per day of demand in 2026, with sort of flattish to slightly declining US growth, and OPEC Plus has unwound all of its excess capacity, and whatever production that can come out of that capacity is fully in the market by the end of 25 or early 26, then the looseness we see in 25 starts to tighten up as we move into 26, because that 1.2, that million barrels a day of demand growth starts to chew up that excess, that OPEC plus supply. And if there's not much of a contribution coming from US shale, that starts to tighten up the market. And on the back half of 26, we could start seeing prices drift into the 70s. So I would sort of say, what do we average second half of 2025? I'd call it sort of mid 60s. What do we average in 2026? We maybe start in the upper 60s, move through into the 70s, and we're probably into, call it the low to mid 70s on average through 2026.
Yeah, no, those are all very good points, Skip. I would just note that I think the way I look at the oil market over the next, call it 6 to 18 months, is I think a potential rebalancing up to the 70s could happen a little bit faster. I think we're likely to see in the first half of 2026 the market getting back to the 70s, and I think even that could get pulled up a little bit into the end of this year, depending on how a couple of key variables go. And I think those key points to highlight are, one, the responsiveness of demand to a lower price, and also maybe to a broader economic environment, if it's able to settle out. I think that's one thing to watch. Two, I think the cadence for U.S. oil, led by shale. I expect that U.S. oil supply to go into decline at some point in the second half of the year, and certainly on a year-over-year basis in 2026 be declining. I think that'll really kind of improve the balance picture, and the quicker the market realizes that, and also the extent of that decline, could certainly get you back to the 70s faster. And I think the last piece of it is OPEC plus. OPEC plus will kind of continue to add supply back, but if they continue to lag, month over month in terms of the actual supply that's added versus what they claim to be adding or plan to be adding, I think the market will also view that as a constructive sign that either OPEC plus intends to add supply more carefully, or that they're actually having a harder time getting the supply going again after years of restraint. So I think I would just counter with a couple of those points. This has been a fascinating discussion, Skip. Thank you so much for your time. Certainly there's a lot to keep an eye on over the next couple of weeks and months. We will look at geopolitics, but also we will look at fundamentals and demand for sure. And let's come back in a couple of weeks or next month to continue this conversation and take stock of where things stand. But Skip, thank you so much for the conversation today.
Yeah, I think it's great. We ought to circle back in a month or so and just see where the market stands.
Thank you for tuning in to the Energy Forum. Subscribe and follow our podcast in the Center for Energy Studies for more expert insights on global energy trends. This episode was produced by Maram Hajazi. AV production was led by Kevin Young. Until next time, I'm Ken Medlock.